Thank you for joining us for this month's National Economic Outlook, written by Local Market Monitor's founder, Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your typical economist. He has a knack for presenting complex facts in an easily understandable way. So without further ado, I'll turn it over to Ingo.
Thanks very much, Julie. Every month, we look at the latest economic data to see what they can tell us about real estate markets, where they are now, and where they may be headed. You make better investments when you have a better idea of the economic forces that affect supply and demand. This month, we'll speculate a bit about what a trade war might mean for the U.S. economy and how that might affect real estate markets. Let's start with jobs, our best indicator of how the economy is doing right now. It's especially important for real estate because more jobs means more demand for housing. This chart shows the increase in jobs in the U.S. economy every month compared to the same month of the previous year. After a long period of readjustment from the losses and regains during and after the pandemic, the annual increase in jobs is hovering around a 1% rate. As we'll see, even this fairly low rate is only due to strong growth in the large healthcare sector, so it overstates the actual strength of the economy. In other words, the U.S. economy right now is already in a fairly vulnerable position. So let's see what job growth looks like in the major sectors of the economy. In the finance sector, there's been stagnation for a while, but with a bump in recent months due to greater activity in the stock and commodity markets, probably in response to government policy proposals. Not much has changed in the large retail sector. Job growth at restaurants, after a long period of rehiring, seems to be settling down at about 1% a year, right in line with the growth of the U.S. population. The big enchilada of job creation right now is the large healthcare sector, which has been growing at twice its normal 2% rate. Slightly lower growth in recent months might signal the end of a long period of rehiring or not. Or not. In the big government sector, growth seems to be reverting to the normal 1% growth after a long period of rehiring at the state government level. I don't know if these numbers reflect recent cuts at the federal level, but government jobs are one of the strongest supports for the housing market. In the business services sector, which usually measures actual business activity in the economy, the job losses of the past year continue, largely because businesses across the economy continue to get rid of temporary workers. This typically happens when businesses are tightening their belts in anticipation of slower sales. But the fact that it's been going on for 2 years may mean a permanent shift in business practices to a slimmer workforce, and these temporary workers will not be rehired. Now let's talk a bit about the manufacturing sector. 50 years ago, at an extraordinary time when all other economies were still recovering from World War II, it employed a third of the U.S. workforce and exported all over the world. Now, less than 10% of American jobs are in manufacturing, and that number continues to fall, despite government efforts to coax jobs back from overseas. New government policies to force more manufacturing back to the U.S. by raising tariffs may have some effect, because some items like pharmaceuticals and computer chips have high value compared to labor input, so there's little economic advantage to make them abroad. But sewing blue jeans is much more expensive in the US than in Vietnam, so jobs where the labor cost is high compared to the value, which is actually most manufacturing jobs, won't return to the US. If a serious trade war breaks out, the immediate effects on US consumers will be mixed. The US imports a lot of beef, so steaks and hamburgers will cost more. It exports a lot of wheat, and if other countries buy less, there will be too much in the US, so bread and hamburger buns will cost less. Maybe the most important indicator of inflation for most consumers, the price of gas, will be lower because a trade war will cause a worldwide recession and less energy will be used. This chart shows the price of crude oil in recent years, around $75 a barrel right now. The green bar on the right shows where the futures markets think the price will go, down around $50 a barrel. What happens with inflation and with a possible recession will have a lot to do with interest rates and the real estate markets. Mortgage rates rose from 3% in 2020 to the current level of 7% and have not come down, even though the rate of inflation has fallen close to 2%. If the economy slips into recession, the Federal Reserve would normally cut interest rates to encourage growth. But if inflation starts up again, the Fed probably will keep rates high. And the high rates right now continue to affect real estate. The overall level of job growth in the construction sector has been easing. Jobs in home building have begun to fall because there isn't enough demand. And a lot of real estate agents are out of a job because there aren't enough home sales to go around. These factors all affect home prices, which have not come down, even though they are 20% higher than local incomes can afford. In the current economic climate, unless a major recession crashes prices, the real estate market will probably not change much. Mortgage rates will remain too high, prices too high, not many buyers, not many sales. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.